A person sits at a kitchen table looking at a receipt for a $7 latte and shaking their head. They log into their bank account on a laptop, smiling as they see automated savings transfers. They review their investment portfolio, satisfied to see regular contributions to an S&P 500 index fund. A montage of financial gurus, books, and online forums, all recommending passive index investing. The person feels confident, imagining themselves as the smart one among investors. A visualization of a haystack with a golden needle, symbolizing the idea of buying the whole market. The person wakes up one morning, checking their phone and seeing news headlines about passive investing. A graphic shows 50% of the stock market investing passively, with crowds of people all doing the same thing. A voiceover from Michael Burry appears on the screen, warning about the passive investing bubble. The cozy hammock of index funds transforms into a crowded life raft in a stormy sea. Nick introduces himself to the audience, sitting at a desk surrounded by financial charts and books. Nick encourages viewers to subscribe and like the video, gesturing to the camera. Nick looks serious, stating that today's topic is whether passive investing has become its own greatest threat. Nick explains the age of the index, showing a timeline of index fund popularity over 20 years. A simple animation illustrates the logic. You can't beat the market, so be the market. Nick points out that for markets to function, people need to actively analyze companies. A group of analysts is shown studying company reports, balance sheets, and listening to earnings calls. The analysts debate the value of Apple versus a struggling retail chain. Nick contrasts this with passive investors who simply buy the entire basket without analysis. Visual of a basket filled with various company logos representing index funds. Nick reveals that passive funds now control more than 50% of U.S. equity assets. A pie chart splits between blind money passive and thinking money active, with passive now larger. Nick explains market capitalization weighting, showing how bigger companies receive more investment. The S&P 500 index is displayed, but the top 10 companies are highlighted as dominating the value. Logos of Apple, Microsoft, Nvidia, Amazon, Meta, and Alphabet appear, glowing brighter than others. Nick breaks down the math. $10,000 invested, with $3,000 concentrated in just 10 tech stocks. A stack of coins labeled with tech company logos, dwarfing smaller stacks for other companies. A scenario shows the top 10 stocks having a bad month, causing the whole portfolio to drop. Nick points out the illusion of diversification. With most money in the Magnificent Seven, a retirement account statement is shown, but the underlying assets are heavily weighted in tech. Nick asks why concentration matters, addressing the audience directly. Nick introduces an analogy. A small town with 100 houses. People in the town evaluate houses based on features and condition, representing active buying. A giant corporation arrives, buying 1% of every house monthly, regardless of price or condition. House prices in the town begin to rise, not due to improvements but due to constant buying. A graph shows house prices climbing steadily, with confused homeowners looking on. Nick explains that this is what's happening in the stock market with index funds. A stream of money flows into index funds every week, visualized as conveyor belts feeding top stocks. Automatic buy orders push up the prices of top stocks, regardless of earnings or fundamentals. A feedback loop animation. Rising prices increase market cap, which leads to more buying next month. Nick looks concerned, emphasizing the dangers of this self-reinforcing cycle. A split screen shows analysts researching companies on one side and passive money flowing blindly on the other. Nick summarizes the problem. Price discovery is being replaced by automatic, unthinking investment. A worried investor glances at their retirement account, realizing the risks of concentration. Nick prepares to dive deeper into the consequences of passive investing's dominance. A stormy financial landscape appears, with index funds at the center, surrounded by uncertainty. Nick invites viewers to consider the hidden mechanics of money and investing. The video ends with Nick promising a serious and honest conversation about the future of passive investing. A final shot of the crowded life raft, symbolizing investors all relying on the same strategy. The screen fades to black, leaving viewers with questions about the safety of their investments. A presenter stands before an audience, introducing the topic of money and psychology. The presenter writes 20% math, 80% behavior on a board to emphasize the point. A montage of people investing passively, clicking buy on investment apps without researching. A visual metaphor of brains being handed over to a robot or algorithm. A flashback to the 1980s. A CEO is caught in a scandal. News spreads. Investors react, selling their stocks in response to the scandal. Stock price graph drops sharply as a result of the selling. A similar scene in the 1990s. A company's product fails, investors sell. Stock price drops again, showing market punishment for bad behavior. Cut to the present. A company in the S&P 500 starts failing. Index funds continue to buy the company's stock automatically. Investors relax, unconcerned, as their money is managed passively. A visual of a buffer forming around the failing company, protecting it from immediate consequences. The buffer is depicted as slowly thinning or cracking. A group of investors stare at a rising escalator labeled market, looking confident. The escalator is shown as magical, glowing, and always going up. A bubble forms around the escalator, growing larger. A narrator points out the psychological detachment of investors. The bubble is shown trembling, hinting at instability. Title appears. The liquidity trap, the exit door problem. Concerned expert Michael Burry is introduced, warning about liquidity. A person easily clicks a button on Robinhood or Vanguard to buy into an index fund. A crowd of people follow, all clicking buy on their devices. The analogy of 100 houses is visualized. A town with 100 identical houses, each owned by many people. Suddenly, all the townspeople decide to sell their 1% share of the houses at the same time. A machine labeled index machine attempts to sell all the shares at once. Potential buyers' active managers examine the shares, frowning and shaking their heads. A thought bubble shows them calculating and realizing stocks are 40% overvalued. The buyers refuse to buy at current prices, stepping back. The price of shares drops rapidly, depicted as a steep cliff. A chart shows a sharp downward gap in prices. Index funds are shown selling all stocks in their basket indiscriminately. Cascade effect is visualized. Selling triggers more selling, like dominoes falling. The market is shown as a tower of cards, trembling. The tower collapses rapidly, representing the index collapsing. Crowd of investors panic as their investments plummet. A new title appears, addressing objections. But Bogle said. A thoughtful audience member raises a hand, questioning the presenter about Jack Bogle's advice. A portrait of Jack Bogle appears, smiling benevolently. The presenter clarifies that Bogle was not wrong, but had concerns. A flashback to Bogle in his later years, expressing worries about index funds growing too large. Bogle warns about blunted competition and corporate governance issues. A visual of index funds growing to dominate the market, overshadowing active managers. A pie chart shows passive investing taking up 80 to 90% of the market. Bogle is shown envisioning index funds as a tool for the little guy to compete with big guys. A small investor uses index funds to stand tall next to a giant investor. The small investors multiply and grow, becoming the majority. The tail index funds is shown wagging the dog the market, causing the dog to get dizzy. The market dog stumbles, looking confused and unstable. The presenter concludes, warning about the risks of psychological detachment and market bubbles. The audience looks thoughtful and concerned, considering the implications. A final image shows the market bubble, fragile and ready to burst as investors watch anxiously. A worried investor sits at a desk, reading alarming headlines about passive investing. Images of stock charts showing rapid growth and sudden drops flash by. Narrator points out that passive investing can be dangerous if done blindly. A visual of a bubble inflating, labeled passive investing bubble, begins to strain and bulge. The bubble shows cracks, symbolizing structural stress in the market. The narrator reassures viewers not to panic or sell everything. A person is shown considering extreme actions like hiding in a bunker with gold bars, but shakes their head and dismisses the idea. The narrator emphasizes making smart, calculated moves. Step 1 appears on screen. Check your concentration. An investor logs into their investment account on a laptop. The investor examines their portfolio's X-ray view. The investor notices they own both an S&P 500 fund and a total stock market fund. A realization dawns. These funds heavily overlap, doubling exposure to the same companies. A graphic highlights the top 10 tech companies dominating both funds. The narrator explains that this isn't true diversification. A suggestion appears. Consider equal-weighted index funds. A chart compares a regular S&P 500 fund to an equal-weighted fund, showing more balanced company representation. The Magnificent Seven companies shrink in importance in the equal-weighted chart. Step 2 appears. Look outside the US. A globe spins, highlighting international and emerging markets. A pie chart shows a portfolio with 15 to 20% international exposure. The narrator explains that international markets are less concentrated and more actively managed. A safety net appears under a tightrope walker labeled US Tech Bubble, representing diversification. Rebalance with purpose. A calendar flips forward by 6 months. The investor reviews their portfolio, noticing tech stocks have grown to 80% of holdings. The investor sells some tech stocks and reallocates to bonds, real estate, and value funds. A scale tips from high risk to balanced risk as the portfolio diversifies. A simple buy low, sell high graphic appears. A passive investor ignores their portfolio, letting tech stocks dominate. A visual of a portfolio becoming dangerously lopsided. Step 4 appears. Understand the why. A child asks, "How does this investment work?" The investor struggles to explain, realizing they don't fully understand. The narrator warns against investing blindly based on advice from YouTubers or books. A light bulb moment as the investor gains clarity about their investments. Revelation. The real danger is the illusion of safety in index funds. A rope ties many boats together, representing systemic risk. The boats float safely as the tide rises. One boat hits a rock, causing all the boats to be pulled down together. The narrator explains that risk is transformed, not eliminated. A group of investors ride an escalator labeled index funds. Most investors continue riding, oblivious to the risks. One investor looks for the exit, symbolizing proactive thinking. The narrator congratulates viewers for understanding the mechanism. The proactive investor diversifies their portfolio, stepping off the escalator. A crowd crush is depicted, warning against following the herd. The narrator urges viewers to check their portfolios and assess their risk. An investor sits at their desk, honestly reviewing their holdings. A calculator and notepad are used to do the math on portfolio risk. The narrator invites viewers to subscribe for more honest investment advice. A comment section appears, inviting viewers to share their thoughts on market concentration. The narrator encourages viewers to keep thinking and questioning. The video ends with a promise to see viewers in the next episode.